What's going on, everyone? I hope you all had a wonderful day today. Today's date is Thursday, November 10th, and we'll be diving into our second cumulative class for our November educational series. If you don't know, my name is Jerry B, and I am happy to have you all here. Thank you all for tuning into the last session. And if you didn't, thank you for coming to this session. So for today's class, we are going to be conceptualizing price cycles under the lens of Wyckoff's market structure theory. So what does that mean? What is Wyckoff and what are price cycles? So as we know, the market moves up and down, but there is some theory to that price movement. And we'll be using Richard Wyckoff's theory to kind of model what we were talking about within the first class, all right? And our key objectives for tonight are going to be Japanese candles. So I'm going to review the slides from last class, as well as dive into the consolidation, expansion, retracements, and reversals. So that's going to be our price cycle, right? And then we're going to talk a little bit deeper into some of the models that we may see within structure using Wyckoff's accumulation and distribution. But I'll also make some time to simplify this accumulation / distribution, because once we get into it, it may seem very complicated. There's a lot of different components to Wyckoff that you don't really need. But if you just understand the bare minimum concept, then it could possibly help you understand why price is doing what it's doing and where it's going to go in the near future. All right. And last but not least, we're going to have an interactive Q&A. So if you have any questions, please save them for the end of the session, and I'll make some time to answer those questions with substance for you all. Interactive ampersand Q&A. All right. So first things first, let's save this as a draft and do a quick review over what we talked about during our first class. So during the first class, we spoke about 3 key candlesticks. I'm not the type to trade candlestick patterns. I think, you know, they work sometimes they don't, and they're kind of random. But if you understand these 3 candles at key supply, demand, then you could have a better, I feel, understanding of what's actually happening within the charts themselves. So the first candle we talked about was the spinning top. The spinning top is like a dreidel. It's like a equal sign. You also have your doji, right, which do the same thing as your spinning top. And whenever you see these candles at key supply and demand areas, key dark pool areas, they're going to signify indecision or some type of reversal. All right. And the way we can confirm that reversal is by looking for the next candle to close under and show some type of strength, going to the downside if it's red for a red reversal, or going to the upside if it's green for a green reversal. The second candle we spoke about was a pin bar or hammer, which is going to signify strength and direction for price action. This candle also can signify a liquidity sweep. So if we take a look at SPY on the monthly, we saw a very strong push to the upside during our CPI catalyst, and that formed a hammer on the monthly, indicating strong momentum or direction to the upside. And last but not least, we spoke about the Moribozu candlestick. I kind of smudged my hand on it after reviewing the notes, but the Moribozu candlestick is going to indicate volume as well as imbalances. Okay, so the Moribozu candle is a rectangle with little to no upper or lower wick. It can be red, signifying downwards volume at key supply and demand areas, or it can be green, signifying strong upwards volume at key supply and demand areas. All right. Now at the bottom, we spoke about the anatomy of the candlestick and how they move. If you take your eye to the open, which is going to be that line right at the body of that red candle, price action opens, comes up to create the high as indicated by the green arrow. And then institutions are going to distribute orders, pushing price down, pushing that candlestick down. Let's say we're looking at a weekly candle. Those orders are going to get distributed to some previous supply, demand, whatever the case is, some previous dark pool level, all the way down to put in a low for step 3. And then for step 4, price pushes up and closes the candle. All right. Now today, we're going to be diving a little bit deeper into what that upper and lower wick candles, today we're going to be diving a little bit deeper into the upper and lower wick accumulation distribution zones and how we can catch those expansive moves or retracements, right, in between the body of those candles. All right. Now, on the other hand, we have our green candlestick. If we take our eye to the open for step 1, we can see that price action gets pushed down first to create a low. That lower wick is going to be recognized as accumulation before an expansive move to the upside. Today, we saw an expansive move into some supply during the CPI catalyst. The range between the open and the close is going to be an expansive move within this candle to put in a high. Once price finds weakness, we can see price push back down to close. All right. But the main thing here that we want to focus on is the body of the candle represents price expanding. It's stretching like a rubber band and getting prepared to either push aggressively to the downside or push aggressively to the upside if we're trading key supply and demand areas or dark pool levels. The main point here is these candles work best whenever they're at key supply and demand areas or dark pool levels. If you trade them at random or within a period of consolidation, you might not get the best results. So that's why it's important to wait for price to come to your point of interest, which was our next point from last week's session. This is a lot of mumbo jumbo going on right here. But if you want to dive a little bit deeper into understanding what went on during this battlefield, please check out the intro to price action, which was lesson 1. But nonetheless, what we can see here is price expanding from these 3. I want you to take your eye to these 3 red candles, right? These Moribozu candles. Price is expanding to the downside, right? So within this model, we were looking to see what is the best risk to reward within structure for it to go to the upside or downside. So price is expanding from this Moribozu, big red candles coming to the downside into some demand. The circle spinning top signifies a reversal. So we're modeling a reversal for price to come back up into the previous Moribozu that was left, that exited supply into demand, targeting some fair value gap. Remember, your Moribozu leaves behind imbalances. They are strong volume candles with little to no upper wick. And as we know, according to the efficient market hypothesis, price action is, efficient. So whenever price leaves a strong demand zone or supply zone aggressively, there may be imbalances, fair value gaps, or inefficiencies left behind that price may later come back to grab or tap into before putting in another lower low or another higher high. All right, so let's take our eye to that blue circle. That blue circle is a chart pattern, let's say symmetrical triangles. Symmetrical triangles occur all the time. And as we know, institutions need liquidity. They need buy stops or sell stops to be able to move the market to the upside or the downside. So if we were to trade a triangle or bear flag, we will obviously model the upside and the downside, wait for a break and retest of supply or support, whatever you trade, into some higher time frame supply. In this case, we were modeling the Fed's event. So price went up into some 4-hour supply. Why? Because it was coming back to fill in some inefficiency left behind from those red candles. At that point, we can model a higher risk to reward to possibly put in, a lower low. And we can see that a little bit better on the circle to the top right. On the circle on the top right, we have that green line, which is going to represent our Moribozu candlestick. Strong hope candle, right? First green candle before an aggressive push to the downside. That's how we identify supply. The Moribozu volume candles, which are red, indicate strong selling pressure. After price sells off from supply with volume, long body candles, right, not the smaller ones, we could anticipate price to return back to that zone before putting in a possibly, another lower low. And today we're going to dive a little bit deeper into that structure and why price may do what it does based upon Richard Wyckoff's theory. Okay, so it's currently 9:10. Let's dive into key objective number 2. Actually, before I proceed, do you all have any questions about the first class? Any questions about the first class or about Japanese candles? 1,000, 2 1,000, 3 1,000. Perfect. All right, let's go ahead and dive into consolidation, expansion, retracements, and reversals. So intro to structure. Richard DeMille Wyckoff. Who is Richard Wyckoff? So Richard Wyckoff is one of the 5 titans of technical analysis. He was an early 19th century analyst who said, the markets move in a very strange way. We have big moves to the upside and big moves to the downside. And he identified that as smart money or institutional activity. And the best way for retail traders to make the best decisions or models of risk within the market is to follow the institutions. And the institutions accumulate orders at some demand zone, and they distribute orders at some key supply zone, right? And he came up with a series of price movements, or phases rather, which are going to be recognized as our accumulation, markup, distribution, and markdown. So from a nutshell, this is going to be our price cycle. We have our oversold zones, which I like to recognize as accumulation, an area for accumulation, where the composite man, institutions, whatever you want to call it, the stock market operator, he's accumulating a lot of orders within this area before preparing for some breakout to the upside and moving the market. The second step, this breakout, this strong impulse move that we like to catch, is going to be recognized as our markup or expansion. Okay, we can see this within the candlesticks by looking at the bodies of our candles and waiting for the accumulation phase to be finished, or just looking for strong Hulk-like green candles. And when price finishes the markup, it's going to redistribute those orders at some supply or some oversold zone. Pardon me, guys. Down here, this is over. Actually, no, I got it right. Price is going to come up after our markup to some overbought zone, which is where we will see orders being distributed. Some consolidation, right? A retest of that consolidation, and then boom, those orders are going to be distributed. So we have phase 1, accumulation. We have phase 2, markup. We have phase 3, distribution. And then we have phase 4, which is going to be our mark down. Okay, now you can see this type of price movement on all time frames, on all of time frames. But the main thing that we want to take away is that before price moves up, there's almost always some area of consolidation. In simple terms, we recognize this as demand. We have the same thing on the contrary when we're distributing orders, we have some area of consolidation, recognized as supply. Okay. Now, whenever price is moving, let's say in a downtrend, what we're seeing are constant breaks in structure. Lower lows, strong lower lows, weak lower highs, over and over and over again. So let's say we have our 4-hour supply. 4-hour supply here, and it's at $100. Let's say the ticker we're trading is X, Y, and Z. Ticker X, Y, and Z is trading at $100. Institutions, once price taps into this 4-hour supply, we're going to go down to, let's say, 15-minute supply. I'm just going to call this M15 for the sake of simplicity. We're going to have our 15-minute supply. Now, when we zoom into that 15-minute supply, 9 times out of 10, once we tap into that 4-hour supply, we're going to see some consolidation, right? Before the next lower low. Why? Because on the higher time frame, the trend has already been confirmed to be bearish. Price has been making lower lows constantly day after day. We're seeing those big, aggressive Moribozu candlesticks pushing price down, right? So when we go to the lower time frame, that's when we'll want to model our trade, look for that consolidation before confirming the movement to the downside, okay? Now, why would price continue to go back to the downside? Because whenever we see aggressive movements from accumulation, demand, or aggressive movements from distribution, supply, remember the market is efficient. It's going to leave behind some fair value gap, some type of imbalance, okay? And the institutions need stop losses. They need trend lines. They need double bottoms. They need double tops, stops above and below in order to move the market, wherever way they want to move it, okay? And the best way to understand where the market is going to go is by doing a top-down analysis, looking at your 4-hour, daily, weekly supply and demand, see where the trend is going. If it's going down, okay, we know the higher time frame is bearish, or if it's going up, we know the higher time frame is bullish. But once we zoom in to the 4-hour or the 15-minute, that's when we want to see, okay, we're seeing a strong consolidation here. Is price targeting some lower high, some lower low, or some higher high to move up into supply to cover an imbalance before making the lower low? Or is price coming back down into demand to target some imbalance before making a higher high? All right, and we'll dive a little bit deeper into that. I have some slides prepared. So I know this is a lot to grasp right now, but don't worry. We'll clear it up by the end of the session. So understanding Wyckoff's price cycle. As mentioned earlier, we have 4 phases. We have our accumulation, we have our markup, distribution, and our markdown. Accumulation is going to be considered bullish consolidation, right? Price is accumulating orders for X, Y, and Z period of time before preparing to put in some higher high or target some liquidity. Whenever I see accumulation on the daily or the weekly, I like to identify them as dojis or spinning tops, because the spinning top indicates indecision. So if I'm at a higher time frame demand zone, dark pool level, then I'm looking for that spinning top, the dreidel equilibrium looking candlestick. Once I see that on the daily or the weekly, then I'll zoom into the 4-hour or the 1-hour to look for consolidation. I'm looking for accumulation, orders being bought up and down, up and down, up and down. before confirming the markup or break out of that structure into some previous supply zone, targeting an imbalance, fair value gap, et cetera, et cetera. The markup is going to be our bullish expansion. After those accumulation orders are complete, then the composite man will probably be ready to expand price. Remember, we have our Moribozu candlestick indicating volume, strong movements to the upside. These Moribozu candles leave behind imbalances, inefficiencies, fair value gaps. All these words are synonymous. They leave behind these orders so that the institutions can later come back to, possibly put in a lower low or sweep liquidity before taking out the previous high that was created. Third, we have our distribution. Your distribution is going to be bearish consolidation. I'm looking for the same thing. However, I'm looking for the candles to be red at some dark pool levels, some strong previous resistance or supply. All right. Now, whenever we're looking at distribution, we're looking to seek a possible reversal, not an expansion. Expansions are when price is stretching up to the upside. A reversal is where price will be coming back down to fill in some inefficiency left behind before the distribution zone, before the distribution phase or zone, whatever you want to call it. Lastly, we have our markdown. We have our bearish expansion, which is where we'll see Moribozu candles, strong, long, bearish candles with little to no upper wick, indicating volume or momentum to the downside. All right. Now, these candles will leave behind supply and demand zones or inefficiencies that we can later target or model within our structure. Okay. Now, I personally don't use many indicators. However, one indicator that I will put on my chart from time to time is the RSI. The RSI has three components: your oversold, fair value, and your overbought. Whenever I'm looking at price action on the 4 hour or the 1 hour, or let's say the 15-minute time frame, I want to see price at this oversold or the overbought zone with a period of consolidation after tapping into some higher time frame. So what does that look like? I want you to picture price moving up aggressively into your daily supply. Once you see price move into your daily supply, you go down to the 4 hour, you go down to the 1 hour, and you see that it's oversold. But on the daily, it's at fair value. So the next thing we will model is looking at the 1 hour and see, okay, price is overbought. Let's say overbought, prices went up into some daily supply, and now it's overbought on the RSI on the, at the 70 mark. When we look at the 1 hour or the 15-minute, we say, okay, what would be the next phase for price to do? Probably continue back to the upside, mark down. You see, we don't know. But the way that we could target this is by looking for imbalances. If there's an imbalance within the internal structure, that's when we could consider puts. But if price action is still showing strength, since it's at the 50 mark on the daily, then that's when we could look for a continuation or, mark up into some old supply zone. All right. Now let's dive a little bit deeper into the expansion component. Your expansion occurs when price breaks out of a consolidation zone while leaving behind an imbalance or order block due to inefficient price action. We can use Moribozu candles to identify this quick impulsive move and use it as a means to gauging momentum. Whenever I see price consolidating, I like to automatically think about equilibrium or doji. The middle part of our consolidation would be considered our 50 mark on the RSI. Below the consolidation would be considered our overbought zone. I always get those two mixed up. Oversold, pardon me. The lower portion of our consolidation is going to be our oversold zone. The higher portion is going to be considered our overbought zone. Okay. So whenever we see price consolidating, we want to look for that break-in structure for confirmation. Here we have a strong break-in structure. Whenever this happens, we might see more Bozu candles. Yes, you could take this trade, but the risk is very high. So me personally, I would like to wait for price to return back to equilibrium, sweep some type of internal liquidity before moving back higher. Because remember, the banks need liquidity in order to move the markets to the upside or the downside. So as price is moving out of this zone, it's leaving behind some inefficiency that we can use to model a higher risk to reward, or we could just, scalp puts back down into this zone as a retest before taking the next expansive move higher. Because if you saw the expansion, you probably already missed the move. It's probably already too late, right? So it's best to wait for price to come back to those discounted levels and then consider, taking the trade. But if you like to scalp the internal liquidity, you could, scalp puts back down or up. It's all about understanding where you are within the structure. So in this scenario, we're going to assume that this range is our 4-hour range. We might see a 4-hour doji or something at supply. But when we zoom in, put on our glasses, this is what our accumulation may look like on the lower time frames. -15-minute or 5-minute time frames. Okay. Now, looking at this, we can see that price has shifted to bullish structure. Why? Because as we're coming down in this downtrend, we can see that a significant high was taken out. A significant low was taken out. And we have a strong period of consolidation before taking out these highs. So once price is once price is in a downtrend, we're looking for the most recent significant high to get taken or break in the trend line. An easy way that you can use is, a trend line break. So price broke structure through this trend line. Now we're looking for equal highs to get engineered above this trend line before considering the break-in structure. Okay. So in this case, we have a double top liquidity or trend line or whatnot. So this gets taken here with our breakout. Now we're looking for price to return back to the double top, double bottom or whatnot, or retest structure before taking the next swing high. And we'll take a look at some of these models in the next slide. So for step 3, we have our retracement. First, we talked about accumulation and distribution zones. They're the same thing as consolidation. As we can see here, we have our period of consolidation. What we might see after price taps into some higher time frame, supply and demand zone, weekly, daily, et cetera, right? And then we'll monitor and analyze the 15-minute, 1 hour, and 5-minute time frames to confirm that the structure internally is bullish. And as we marked up earlier, we saw a significant high taken after that trend line break. Price created a double top, equal highs, indicating strong points of interest for moving price higher, but failed to put in another low. So first, confirmation is going to be a break in structure. I like to look for Moribozu candlesticks if I'm long. Green Moribozu candlesticks if I'm long. Bearish Moribozu candles if I'm short. So I see a big Hulk candle. Okay, this big Hulk candle left behind some fair value gap after the initial trend line break, which is indicating bullish interest. I'm waiting for price to form equal highs, equal lows. Once price targets this liquidity, takes it out, that's when I'm waiting for a pullback into the discounted levels before looking for the next higher high or higher low if the structure is bullish. Same thing if it's bearish, which is what we'll be talking about during the retracement slide. All right, so our retracement are going to be pullbacks or retests into a previous consolidation zone. For our bearish scenario, we can see here that the trend has turned bearish. Right, we're in a downtrend. Price action is bearish here. Let's say this is a 4-hour spinning top. But when we zoom in, we're looking at price action on the 15-minute or 5-minute. First things first, what I like to look for is a strong bearish Moribozu order block or whatnot to form right after a green candle push into that zone. Remember, our Moribozu candles are going to leave behind fair value gaps that we can later target to model within our internal structure. So if we miss this initial move down, we can wait for price to tap into some demand, trade the way back up, targeting the gap that was left behind or inefficiency, or we can just set our alerts, walk away, and then target the inefficiencies left behind after the expansive move back up into that supply. So in this case, we can see we obviously have a strong break in structure. This is a significant low. So if price action doesn't take out these highs, these higher lows, then we know that the trend is still bearish. However, although the trend may be bearish on the 4-hour, we can still trade within the internal structure longs up into some fair value gap within structure. Okay. Now let's take a look at what this may look like for Wyckoff. As we can see here, there's a lot going on with Wyckoff. You have 5 different phases: phase A, phase B, phase C, phase D, phase E. However, whenever we're looking for accumulation, I like to personally focus on phase B and phase D. Why? Because in phase A, we can see that price action gives us a strong rally after tapping into supply. That's AR, it's automatic rally. Once you see price going into your demand zone or going into some, let's say, dark pool level key area of support and you see a strong bounce, right? Or impulse move, Moribozu candle signifying strength, that's going to be considered our change in character. So that means the trend is shifting. Price is in a downtrend. In phase B, I'm looking for Moribozu candles. Once I see that Moribozu candle, I'm like, okay, phase 1 is complete. Step 2, I'm looking for equal highs. Once I see those equal highs get taken out, that's when I know that's phase B. All right. Phase D, I'm looking for those equal highs to show signs of strength to the upside. Phase D, so breakout, I'm looking for price to come back down into a discounted area. And that's when I will model my risk to reward for some upside movement, right? So earlier, we talked about waiting for that Moribozu confirmation after being in a strong downtrend. Price is clearly in a downtrend. We see price break trend. That is going to be phase B for me. Now I'm looking for liquidity to get engineered for the upside, equal highs. Now, once those equal highs get taken out, that's when I like to wait for a retracement, targeting some internal liquidity at the most recent demand zone before modeling the next trade to the upside. Now, if you are a breakout trader, you can obviously trade the breakout for a quick scalp, or you could trade the retracement for a quick scalp. You know, it's all about understanding the type of trader you are and modeling your risk according to that. I like to wait patiently, so I will wait for price to come back down into that equilibrium discounted level for a higher risk to reward. Right, so that is going to be that. What's going on, Peter? I'm gonna just mute you real quick, buddy. No hard feelings. All right. So phase D, look for your trend line break. I'm sorry, phase B, look for your trend line break. Phase D, sign of strength. I'm looking for equal highs or equal lows to get taken. Once I see the retracement back down into the most recent supply or demand zone, that's when I'm modeling my risk to reward to take out the previous higher high. As we can see here in this model here, we have our break in structure, strong impulse moves to the upside. We have our consolidation period. I'm waiting for price to sweep liquidity within the internal structure at our demand zone, and then I'm targeting those equal highs. In this case, they're not equal, but you know, sometimes you'll have trend line liquidity up here that you can target as well. We have our strong break in structure. We may see a Moribozu candle. It's always the Moribozu for me. If I ever see a Moribozu candle at 4-hour supply and demand, and I'm looking for that imbalance to get filled before looking for those longs. All right, so we have our Moribozu candlestick leaving behind an imbalance. We can see that price action wants to go higher, as indicated by the break in the previous high. Now we're looking for some type of liquidity, sign of strength. We have our liquidity buildup. I'm waiting for the retest. I'm looking for price to come back in, tap into the most recent demand zone, the most extreme demand zone within structure before the next swing high targeting these weak higher lows. All right, so now we have our reversal or change in character. So this is going to occur whenever price moves in the opposite direction within the internal structure of the overall market trend. In our previous example, we have a bullish channel being formed, right? Price sweeps those stops within the lower time frame and targets the most extreme demand zone before giving us a higher high. Now that would be considered a retracement back into supply. And here are some more extreme, more common, not extreme, but more common examples of price being tapped into extreme supply and demand zones. So for example, one, we can see here that price action gave us a green candle, hypothetically. We see some strong Moribozu candlesticks indicating strong momentum to the downside. So it's going to be a strong low. The trend is obviously bearish, right? But remember, whenever we see those Moribozu candles, they're going to leave behind some fair value gap. Remember, the bank need equal highs, equal lows, and trend lines to target or tap into the most extreme supply and demand zones. Let's call this H4 supply. The banks need stops before being able to move the market. So we have these significant lows. Price taps into our most extreme supply, fails to make a higher high, so we put in a higher low. And now we can target this liquidity that was left behind from the previous impulse move or expansive move into supply. So we could trade the break of trend, right? But the odds of catching that move are very slim. So I will wait for price to break the trend, tap into some higher time frame supply, and then look to target some inefficiency to the downside to put in another lower low if I'm bearish. All right. Now, on the contrary, if we're bullish, we have our first red candle before some Moribozu impulse moves to the upside. So that's going to be step one, phase B for Wyckoff. Break in our trend line. Phase D, I'm looking for equal highs. Once those equal highs get taken out, showing some type of sign of strength, I'm looking for the fair value gap that was left behind after the trend line break to get filled. Before targeting these previous highs. Okay. Now we can see here, there's some internal liquidity. This may be in the form of bear flag, ascending triangle, equal lows, equal highs. Equal lows and equal highs are the easiest to identify. So I, model my trades mainly around equal lows and equal highs. So the overall structure is bullish because price put in a significant higher high. So when we go to the internal structure, we're looking for liquidity before the fair value gap that was left behind from our Moribozu before targeting the previous swing high. All right. So for Wyckoff, we have 4 different phases that we want to be mindful of whenever we're modeling or analyzing price within structure. We have our accumulation for step 1. We have our markup phase, step 2, which is going to be our expansive move. That's going to be the body of our candlestick on the daily or the weekly. Step 3, we have our overbought, which is going to be our distribution zone. I like to identify these as spinning tops at key supply and demand, dark pool levels. Once price gives me a break in structure, I'm looking for the Moribozu candlestick indicating volume or momentum to the downside. Then I'm looking for an expansion back into that Moribozu, filling some fair value gap before the next swing low, targeting some previous imbalance that was left behind. Okay. And that leads me into accumulation versus distribution simplified. So earlier we spoke a little bit about Wyckoff accumulation phase. So the accumulation phase, you have all these different components that you can mark off, but I don't really think they're significant to remember. It just overcomplicates our trading. But in a nutshell, the way I like to simplify is if we are at, let's say, 4-hour demand, I'm going to call this H4D. If we are at 4-hour demand, we see prices in a downtrend. We get that Moribozu candle, strong impulse move to the upside. That's going to be considered my changing character, quote unquote. There are many ways to identify changing character, but this is what I look for if I'm in phase B. Step 2, I'm waiting to see the equal highs or equal lows. Once those equal highs or equal lows get formed and taken out with another Moribozu candlestick or showing me some type of strength, that's when I'll look for the most extreme demand zone within the internal structure, let's say on the 15-minute. So this would be considered a retail breakout. I'm looking for price to retrace back into that 15-minute zone, and I'm targeting this high within the model. Risk below the supply zone or demand zone in this case. Reward, we're looking for price to put in another higher high after showing strength from this trend line break. And the reason we're looking for price to continue higher is to target some imbalance at the higher time frame, at the previous supply zone that caused the downtrend in the first place. All right, let's back test a quick example so you all can see how price action reacts in real time. So what we're going to do here is go to the daily and find a spinning top. So here's the most recent spinning top on the daily. This is the most recent spinning top. Price action came into this daily demand zone, daily demand. And we know that it's daily demand. Why? Because we see our Moribozu candle, strong momentum to the upside, big momentum to the upside. I see some equal lows here. And once those equal lows got taken out, the momentum slowed down once price action retested this demand zone. If price were to continue, we look for this low to get taken out, look for a retest, tap into our demand, and then target this significant low here. However, since this low here didn't get taken out, the trend is still bullish. Why? Because we see aggressive momentum to the upside after our break and trend. We got our break and trend, and we have our continuation break and structure. So the best way to really enter this trade is to wait for price to return back to the most extreme demand zone and target these equal highs. All right, so phase B for Wyckoff. It's going to be our break and trend. Phase B, our break and trend. Breaking the RSI at the 50 mark. I'm looking for price to retrace back to this extreme demand zone before putting in the next higher high. Okay, this is a daily example. Now on the daily, let's just say we see, okay, price came back down to this daily demand and I recognize this spinning top. This spinning top tells me this is the strong area of distribution. I'm sorry, strong area of accumulation. The spinning top and the Moribozu up here tells me this was a strong area of distribution. Why? Because I see my Moribozu candle selling off at the previous support. Bearish engulfing, price breaks through, comes back up to retest structure, and then falls off. Strong selling pressure here. Remember, whenever we see those Moribozu candlesticks, there's an imbalance that is left behind that needs to get filled in. As we can see here, these wicks do not touch. So this is an imbalance that was left behind at the most extreme supply. So price's reason for coming back up here was to fill in this imbalance. The wicks aren't touching. So you have our first green candle before an aggressive push to the downside. We have step B, breaking structure or breaking the trend line. Now we're waiting for price to tap into our daily demand, which is our spinning top that we found. Once we go down to the lower time frame, for this scenario, since I started on the daily, we'll just take a look at the 1 hour. Price taps into our daily demand, the spinning top here. That's this range. We're looking for equal lows to get swept within this internal structure to target the previous high and the left behind imbalance from our Moribozu candlesticks or sell-off. But overall, we know that price is bullish. Why? Because it broke trend on the higher time frame. We're just waiting for price to come down to a point of interest, to model our risk to reward to the upside. I wouldn't enter, longs up here. I'd wait for price to come back down into that area of consolidation, daily demand, spinning top, before looking for longs higher. But first, we need to make sure we have our break-in structure. Structure needs to be bullish or bearish to confirm the momentum to the upside or the downside to put in a higher low. But long story short, remember, price action always has to have a cause and effect. The best way to model our risk to reward is to understand where the most extreme supply and demand zones are, where we are within the internal structure, and identify the liquidity. The liquidity can be recognized as trend lines, which is step B for me, looking for that Moribozu candlestick for step B. Step D for Wyckoff is going to be equal highs or equal lows. Once I see those equal highs, I'm waiting for equal highs or equal lows. I'm waiting for either one to get taken. Once the equal lows get taken, but it fails to put in a lower low after the phase B, which is our Moribozu breaking the trend line, that tells me that price wants to continue higher, okay? I like to model my risk to rewards based upon the spinning tops because the spinning top indicates a period of consolidation on the daily, weekly, or 4 hour. After that, zoom into the 1 hour, look for your equal lows or equal highs, and pretty much you're just looking for another impulse move, strong, aggressive, bullish candle to get filled in after tapping into your supply zone. And that is going to conclude today's session. I'm now going to open it up for question. I went a bit over time. So if you all have any questions, feel free to let me know in the chat. Confused on what liquidity means? Great question. So think of it like this. Let's say you mark off 2 touches of support, 2 touches of resistance, and you put your stop loss at that support and you're betting on the stock to go down. If you get an alert that price action is going up and you think it's going to go down, what are you going to do? You're going to check your phone, look and see, okay, why is price going back up? Now, if you sell, that means that the longs are in favor. Liquidity is nothing but stop losses, right? And the best stop losses that are going to move the market are equal highs and equal lows or trend lines. So liquidity is just, stop losses. And the best forms of liquidity that we talked about today are going to be trend lines, you have buy stops above, you have buy stops below, sell stops below. You have equal highs, and you have equal lows. You can use these forms of liquidity, trend lines, equal highs, equal lows, as a means like fuel to target some fair value gap above or below. And for class 3, we'll be back testing for the entire class and just bringing everything together. using our liquidity concepts. But in a nutshell, it's just stops above or below. Equal highs, equal lows are the best forms of liquidity for me whenever I'm targeting those imbalances in the Moribozu. Of course, my pleasure. My pleasure. Where can I see class one? You can see class one under useful links in the Discord. So if you scroll down to useful links, the link to class one is here. My pleasure, my pleasure. All right, it is currently 10:01 and I realize you all are very busy professionals. So if there are no other questions, I'm gonna go ahead and conclude the class, but I do have like 5 more minutes to answer any other questions y'all may have. Want to take a look at a chart, et cetera, just let me know. So I'm gonna end the class in 5 1,000, 4 1,000. Ooh, I almost fell. 3 1,000, 2 1,000, 1 1,000. Awesome. Thank you all for your undivided attention and listening to me speak about structure. I look forward to our third class, which is where we'll be doing some real-time back testing and talking more in depth about the liquidity concepts in real time. But nonetheless, I hope y'all have a blessed night and I'll see y'all tomorrow. ODT Friday, baby. Let's do it. Take care, y'all. Have a good night.